What if I told you there's one simple, almost beautiful rule that governs the entire messy world of business finance? From the corner coffee shop to a global tech company, it all comes down to one thing. And today, we're going to break down that fundamental rule, the accounting equation.
I mean, really think about that. How can anyone, an investor, a bank, or just you, get a crystal clear snapshot of a company's financial health? How do you peek at its DNA and just know where it's strong and where it's weak? It sounds impossible, right? But the answer is actually incredibly simple.
So here's our game plan. We're going to crack this code together. First, we'll look at the equation itself. Then, we'll take apart each of its three key pieces. And finally, we'll put it all back together and see how this thing really works in action.
Okay, let's dive right in. The secret to understanding any company's financial situation isn't buried in some 100-page report. Nope, it's all right there in a single equation.
This one formula, you guys, is the absolute bedrock of all accounting. It's like a law of physics for business. It tells a complete and perfectly balanced story about any company at any given moment.
And here it is. Assets equals liabilities plus equity. It's as simple as that. It's a statement of perfect balance, like a scale. On one side, you have everything the company has, and on the other, you have how they paid for it all, either by borrowing money from others or by using the owner's own money. So let's break down what each of these really means, starting with assets.
Let's start on the left side of that scale. Assets. This is the easy part. It's basically all the cool stuff a company owns and controls.
So the textbook definition sounds a little dry, but here's the deal. An asset is just anything that company has that's expected to make it money in the future. Just think of it as what you own. And these get split into two main categories. First up, we've got current assets. Think of these as the fast-moving items. It's stuff that is either cash already or can be turned into cash pretty quickly. We're talking within a year. You know, cash in the register, money in the bank account, products sitting in the warehouse waiting to be sold, and even money that customers still owe you.
Then, on the other hand, you have the non-current assets. These are the big-ticket, long-term players. The things a company needs to run its business but isn't planning to sell anytime soon. We're talking about the office building, the delivery trucks, all the computers, and the heavy machinery on the factory floor.
Okay, so that's all the stuff a company owns. But where did the money come from to buy all those buildings and trucks and computers? Well, that takes us to the other side of the equation, and we'll start with liabilities.
Liabilities are basically claims that other people have on the company's stuff. Or, to put it even more simply, it's what you owe. This is all the money that the company has borrowed from others to get its assets.
And yep, you guessed it, just like assets, liabilities are also split into two groups. Current liabilities are the debts that have to be paid back soon, usually within the year. This could be money owed to suppliers, a short-term loan from the bank, or, taxes that are coming due.
And then you've got the long-term liabilities. These are the debts that are kind of on the back burner. They don't need to be paid off for more than a year. Think of a big multi-year mortgage on a building or bonds the company sold to raise money for a huge expansion project.
Okay, so we've covered what a company owns, and we've covered what it owes to everybody else, but there is one final and honestly the most important piece of this puzzle: equity. This right here, this is the bottom line. Think about it like this. If a company had a giant everything-must-go sale, sold off every single asset it owned, and then used that pile of cash to pay off every single one of its debts, whatever's left over, that's the equity. It is the owner's real stake in the company. It's the true net worth.
So, what makes up this equity? Well, it's things like the initial cash the owners put in to start the business. That's capital. And it's also any profits the company has made over the years that it decided to reinvest back into itself, which we call retained earnings.
All right, we've defined all three parts: assets, liabilities, and equity. Now it's time for the big reveal. Let's put these pieces together with a simple example and actually watch the equation come into perfect balance. This is where the magic happens.
So, have a look at this table. On the left side, you see all the company's assets: its buildings, cars, cash, inventory. And on the right, that's the story of where the money for all that stuff came from. You see its liabilities, a loan, some formal IOUs, money owed to suppliers, and right below that you see the owner's equity, the capital they put in themselves.
So let's run the numbers real quick. On the asset side, we've got $30,000 for buildings, plus $10,000 for cars, $15,000 in cash, and $45,000 in goods. Add all that up, and we get a grand total of $100,000 in assets.
Okay, now for the other side. Let's tally up the liabilities. That's a $10,000 loan, plus $5,000 in notes and $15,000 to creditors. That's $30,000 in total debt. Now, add the owner's $70,000 in capital, and what does that give us? $100,000. Perfect.
And there it is, the golden rule in action. 100,000 equals 100,000. What a company owns is always equal to what it owes to others plus what the owners have put in. This isn't a maybe or a sometimes. It's a law. Every single financial transaction, no matter how small, has to keep this equation in perfect balance.
So the next time you walk into a store or see a massive corporate headquarters, just remember this equation. You now hold the master key to understanding the financial story behind any business. Everything you see, all the assets, is being paid for by a mix of debt and ownership. And the story of that mix? Well, that tells you just about everything you need to know.